Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the second best day of the week as we get ready to wrap this one up. Thank goodness. Been a little bit of a rough week so far. We're going to have a little bit longer before the bell segment this morning. I'm going to go through several of the major markets and just kind of get an update as to kind of where we are right now. So we'll go through that in just a minute. Outside of that, yesterday it was interesting. The S&P Global Services Index had a fairly big increase. And what's interesting is I got a lot of phone calls yesterday about, oh, look at this index. It says the economy is doing great. The problem is that nobody really pays attention to the S&P Global Index because it doesn't really jive with a lot of all the other data. Again, you take a look at ISM services and manufacturing and a whole variety of other economic indicators certainly showing the economy is weakening both on service side as well as the manufacturing side. So I got a lot of emails asking me about this one index, and it's fine. There's nothing wrong with it. It's just that it doesn't get a lot of attention because it deviates so much really kind of from where everything else. And more importantly, it's a global index versus a U.S. index. And what we're concerned more about in relation to the stock market, et cetera, is what's happening in the U.S., of course. Again, that really didn't mean a whole lot. That didn't have anything to do with the sell-off in the market yesterday. We'll talk about that here in just a second. Outside of that, today we're going to get the first estimate of the second quarter GDP. Now, the Atlanta Fed currently expecting around 2.7%. That's a fairly sharp increase from the 1.4 that we saw in the first quarter. We'll see how it actually comes out today. Again, the Atlanta Fed's kind of been all over the place as of late. It was as high as 4. It was at 1.7. Now it's at 2.7. So it's really been a volatile number for the Atlanta Fed number this month. Most economists are expecting somewhere between about 1.8 to 2.1. So still, and still just with that though, that's still fairly robust economic growth for the current cycle that we're in. So again, no real recessionary impact right now, but you got to be careful with that though when you say that, because if you go back in history and look at the 1 quarter prior to the onset of recession, GDP was about 2% in many of those cases. So in other words, we went into the quarter going, hey, economy's doing great, we're at 2%. The next quarter the recession started. Now remember, the recession is backdated. So we really don't know where the recession will start. If we're going to get one, we don't know where the recession is going to be or where it's going to start because it'll be 8 to 12 months after the official start of the recession is indicated. But right now, there's not a lot of indications that suggest a recession starting. Yes, employment is ticking up. Temporary hires are declining. That's certainly kind of some of those warning signs. The 2-year, 10-year inversion on the Treasury yields, that's very, very close to uninverting. That is, and again, this is one of the big mistakes that a lot of the media makes. They go, oh, the yield curve is inverted. That means there's a recession coming. It's the uninversion. It's when the yield curve uninverts that the recession usually begins, because that's where the Fed is cutting rates to offset some type of economic weakness or financial event, credit event, etc. We're not there just yet. So again, this is one of the reasons that we haven't seen a recession at this point, is because we haven't got to the part to where the Fed's having to cut rates to offset an economic recession. Now, that's an interesting part and something that we'll talk about this morning with Michael Lebowitz. The market is now expecting a 50 basis point rate cut in September and 3 rate cuts for this year. So all of a sudden we went from 1 rate cut, we're now back to 3 with this recent sell-off. So let's talk about what you need to know before the bell this morning, because that's what everybody wants to know is what happened yesterday. We've gone roughly about 350 days without a 2% correction. Finally got one yesterday. Market was down about 2.3% yesterday. The market did break through the 20-day moving average, came back down and tested the 50-day. In today's market commentary that's on the website this morning, we talk a little bit about this. Again, we noted yesterday we're on a sell signal. Again, that is certainly putting pressure on the overall market. We've talked about for about a month now, a little bit more than a month, we're due for a 3 to 5 to a 10% correction. We're in that process. Now, whether we're going to continue that correctional process or not is yet to be seen. The market is now sitting right on the 50-day moving average. If the market can hold here, rally back up, clear the 20-day, we'll go back and retest highs. This correction will be over. If we fail at the 50-day moving average, we're going to come down and test the 100-day moving average. Now, if we go back and look at April, it's exactly kind of the same layout we had in April. The market was well extended, and back then we were talking about, hey, we need a 5 to a 10% correction. Market came down, broke the 20-day, just like we did a couple of days ago, rallied back above it, thought the market was okay, then we broke back down, cut right through the 50-day moving average. So again, same thing here. Rallied a couple of days above the 20-day, broke down, we're sitting on the 50, very close to kind of what we saw previously, and then the market went on down, tested the 100-day moving average. Right now we've got downside to about 51.78 on the S&P, so that'd be about a 5-6% correction by the time we get there. So again, pay attention to that. We're on sell signals really across the board. So again, it does suggest further weakness, and we're in that time of the year, July, August, September, October, where that kind of correctional process is usually in play. So this may be just kind of all playing out to normal seasonality, a bit of de-risking going into the election. Talking about a couple other markets real quick. Emerging markets, it kind of got a big jump with small cap stocks. That's given all that back up again. So again, that shift to other stocks outside of mega caps worked well for a moment, and then now has had a pretty big decline. Sell signals here across the board as well. International markets have broken down back below their moving averages as well, back on a sell signal. They didn't really get a whole lot of activity with the rotation in the market, but those are breaking back down again. Small cap, mid cap, looking at the Russell 2000, is still doing well at the moment, but it is starting to peak here. We had this little brief rally where it grossly outperformed, got a lot of attention, really outperformed the large cap index, but has peaked at that level, has been unable to get back above that level, still overbought here, kind of on a standard deviation basis above the 50-day moving average, beginning to trigger sell signals. So we may see more of a reversal in that small cap, mid cap trade. So don't forget to take profits, because as we talked about earlier this week, these companies are still challenged on a profitability basis. And if earnings are slowing, and if Google and Tesla and these other big mega cap companies that were the growers of earnings, if we're seeing earnings deterioration in those companies, it's certainly going to kind of roll down the list because the economy is slowing down overall. Outside of that, the other big news yesterday, Treasury yields took a pretty big jump. Again, yesterday was a big liquidation across the board. We saw stocks, bonds, everything kind of get liquidated yesterday. So yields had popped back up, but we're still within this downtrend. We had kind of talked about this previously, that we're just in this downtrend in yields. And so again, just kind of bouncing along this downtrend. Again, a big pop in yields yesterday, but really it was kind of just a market unwind yesterday. Really not anything news driven to any consequence. Just pretty much a de-risking of portfolios across the board yesterday. So we saw yields pick up here as well. There is some more potential upside here to the top of this trend channel. Could get back up to about 4.33, 4.35 on the 10-year Treasury yield. So again, there is some upside here on yields, some pressure on bonds potentially. But over the course of the next few weeks, we're going to work through this correctional process, likely be back into a good buying position. So again, as we get ready to head into the end of the year, but it could be choppy for a couple of months. So again, we took profits earlier last week. Suggest you do the same, risk manage your portfolio a bit. Don't be overly negative right now. No reason to. We're just through a normal correction process. This will be a buying opportunity unless something else comes up. And right now, we just don't see it. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk about the Fed and your money. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Okay. Good news this morning is that I don't have to fast anymore. I had my physical yesterday. I don't know if I'm dying yet or not. That's the bad news. It'll take a couple of days to find out. But they took my blood, so we'll see what happens. I don't give that stuff up cheap, by the way, right? I keep all my blood. My blood belongs to me, so I keep that. I give it up, very begrudgingly.
Your blood, your choice.
Exactly. This is exactly right. My right. But anyway, that means that this morning I can now have coffee. So I am not nearly as cranky as I was yesterday. So good news. This morning, of course, Michael Lebowitz joining me. Lots of stuff to kind of get into. Obviously a fairly sharp correctional process yesterday kind of caught a lot of people flat-footed. I got just tons of emails yesterday. It's like, oh my gosh, what's causing this? Look, if you're not going to read our newsletter, read our blogs, listen to our radio show, don't email me. We post stuff. Literally, we post stuff every day on the website at realinvestmentadvice.com. We have a daily market commentary that we post. We post a weekly newsletter that's free. We post daily blogs 3 times a week. They're free. We've been discussing now for a month and a half. We're going to have a correction. Here it is, right? So don't email me going, oh my gosh, what's going on? If you're not going to read and listen, don't email me. Now, if you do read and listen, you want to email me, ask me questions, happy to answer those. My dad always said, no question is stupid if you don't know the answer. But if you don't know the answer because you're not reading or listening anything we say, it's a stupid question. I won't answer it. So we're just going to be just right up front with you right here.
Good thing you're not cranky this morning.
I'm not cranky. I'm actually in a very good mood this morning because I have coffee. And it's Black Rifle. So
yeah, baby.
This message brought to you by Black Rifle Coffee Company. Now, let's get Michael Lebowitz here on the show. He has had no coffee this morning. Right, Mike? And
it seems like
he's had so
not
much coffee.
caffeinated.
Exactly. I know. I'm in a good mood this morning. I'm just teasing. So look, let's talk about a couple things. Bill Dudley came out yesterday and said the Fed needs to be cutting rates now. And I thought that was interesting because this is the guy that said prior to the election between, the previous election in 2020, the Fed needs to be hiking rates aggressively. But the Fed's not political, right? So I just thought his comments yesterday were interesting. But he is calling for rate cuts now. And we are seeing Fed funds futures now creep up, expecting a 50 basis point cut in September. And that's certainly kind of a notable change over since last week when you were here.
Yeah, you know what? I think the best way to explain it if you go back and look at recessions, what we find is that we didn't know we were in a recession till usually a little bit later. In fact, the NBER is the one that determines when you're in when you're in a recession, when it started, when it ends. And typically they'll tell you, they'll assign the recession after the fact. So a recession may start in March, but they won't even call it a recession until we get to August, September, maybe even later than that. And a lot of times we don't even know we're really in a recession until a couple months after. And I think that's what Dudley's saying, is that monetary policy is extremely tight. It's much tighter than it should be based on the two Fed objectives, prices and the labor market. The labor market's strong, but it's certainly showing signs of weakening. The unemployment rate's up to 4.2% now. And typically every time that you've had a turn in the unemployment rate and it's gone up, a decent amount, I forgot the percentage for the SOM rule, but a decent amount.
Real quick, let me just jump in. It's when you are 0.5% higher than the 3-month average.
Right. And so we're 0.5% higher. We're there. And that has caused a recession every time. We know the yield curve inversion, and then the uninversion, which we're getting kind of close to now, is another telltale sign of a coming recession. And inflation is down to 2.6%. Core inflation is down to 2.6%. It's not 2%, but it ain't 7 or 8% either. Right. It's much closer to target. So I think what he's saying is, if you look at everything, we're pretty much normal. And the situation, prices are coming down, labor market's weakening, rates are too high. They're 2 to 3% too high. Why not, just hedge yourself a little bit and cut rates, and do it sooner, because you don't know when we're going to be in a recession. And the longer you wait, the worse that recession potentially is. So, and I agree with Dudley. We've as you say, we've put this in our commentary. We've written blogs. There was a commentary, I think it was a week or two ago, that flat out the title was Fed funds are too high. And we explained why. So, again, but I think what's holding back Powell and the Fed is that they're scared to death that they're wrong again on inflation, and that by cutting rates, somehow they spur inflation, and then they have to raise rates a lot more again. And I think there is some awareness around the election, and they don't want to be seen as swaying voters, by cutting rates.
Well, if you cut rates by 50 basis points prior to the election, that's kind of going to be a sway to voters, right?
It will, and that's why maybe if you cut 25 in July and say we may do something at the next meeting, that may be politically a little bit more, acceptable.
Yeah.
Yeah.
Of course, this is coming from a guy that lives next to D.C., so just, saying that.
Yeah, look, I'm not a huge Bill Dudley fan. He actually used to work for Goldman for many years, so
yeah,
the combination of Fed and Goldman doesn't sit right with me. But he really does, he's a smart guy. He knows how this stuff works. Whether he's doing this for political purposes or because that's what his true opinion is, I don't know. But I agree with what he wrote in the Wall Street Journal yesterday, that Fed funds are too high.
Yeah, and one of the problems for the Fed, and it is always the case, is that you're looking at current economic data, which first of all is lagging, right? So you're looking at 4.1% unemployment from the last month. You're looking at GDP from the previous quarter. So all the data they look at is lagging. And then the second problem is that they go, well, there's no recession here. We can keep monetary policy where it is, blah, blah, blah. And then in the next month or two, you get a massive set of revisions that come through the data that completely wipe out that narrative. And then you're behind the curve. And now you're having to go, oh my gosh, now I've got to really cut rates, or something, fractures in the credit markets. And we're starting to see some stress and delinquency rates for auto loans as well as credit cards. Those have been rising fairly sharply. We're seeing credit spreads on the junk side of the ledger beginning to widen out a bit. Now on the quality side of the bond market, there's no stress yet, but you're starting to see kind of those early warning signs that that there may be some stress, both economically and financially within the markets that can really kind of sneak up and surprise you. And this is usually why the Fed gets caught behind the curve, is because they're like, oh, everything's fine. And then something fractures and they're like, okay, now we got to cut rates dramatically. So, it's a guessing game in a lot of cases.
And I would add to that, some of the reason it's a guessing game is because a lot of it is confidence. It's the confidence of consumers and corporations, and confidence can change quickly, right? I mean, we see it in these election polls whipping up and down. People's opinions change rapidly. And with the economy, if, let's just say this last week or two sell-off in the market, some people are going to be holding back on purchases. Oh, my 401k is down 4 or 5%. I just lost some money in my brokerage account. Let's just not go out to dinner. Let's not go to the movies. Maybe we'll only go on vacation for 5 days instead of 7 days. All that can have an effect on the economy. It's said that the stock market leads the economy by 6 months. Maybe it's that the stock market is what causes the economy to do better or worse. Right? We talk about financial conditions. The financial conditions indexes are not based on how easy or hard it is to get a loan. It's based on what has the stock market done recently, and some of it's based on credit spreads in the bond market. So when the stock market's doing well, people are confident, they're more comfortable spending money, even if it's just your 401k growing or a small brokerage account. It breeds confidence. And conversely, a down market breeds a lack of confidence, and people start pulling back on their wallet. And so, right. Confidence, it's just too hard to predict. It's like the weather. It's a dynamic system. It's always changing. That's why they can't predict the weather 5 days out with any accuracy, because there's so many things that will affect the weather 5 days from now that haven't happened yet.
Right.
And it's the same with the economy.
Well, no, and look, it's a great point. Ben Bernanke back in 2010, so when we had done quantitative easing part one, coming out of the 2008 financial crisis, and that ended in June of 2010. And immediately the market began to sell off. We started to see a contraction in sentiment, et cetera. And in September, Ben Bernanke comes out and they announce quantitative easing part 2. And his specific statement was, he said, look, the reason we're doing quantitative easing is to boost asset prices, which will in turn lift confidence, which will spur economic activity. And that's exactly to the point that you're saying, is that the Fed is very aware that stock market performance has a lot to do with confidence. And so if there's going to be, and again, if this is just a mild correctional process that we're in, that's one thing. But if this correction really starts to gain some traction and you're starting to really bleed over into economic confidence, the Fed is going to cut rates more aggressively to help boost those asset prices, because they need confidence in order to keep the economy out of a recession. We'll come back, talk some more about that after the break. Which also kind of ties us right into Mike's new article talking about irrational exuberance, the difference between then and now. We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
This is the worst coffee on the planet. I'm filing a class action lawsuit against my firm for buying this coffee. It's absolutely terrible.
The Real Investment Show podcast.
I think you bought this coffee too.
I offered you some Death Wish coffee.
I don't want to die this early in the morning.
Same show, your schedule.
There needs to be a nice balance between coffee brands, okay? Can't have complete crap and Death Wish. There's got to be something in the middle.
At realinvestmentadvice.com.
Black Rifle.
There you go. We don't have any here, do we?
No.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, Michael Lebowitz joining me as well. Talking about, as we were just talking about just for the break, the stock market has a lot to do with confidence, and confidence is what drives the economy. If you feel better about your financial situation, you go out, you buy more stuff, you spend money, you go out to eat. If the markets are declining and you're losing money in your portfolios, then all of a sudden, maybe we don't do as much, right? And then that certainly has an impact to the economy. And so sentiment's very important to a lot of things. One, it's sentiment is a large position behind what happens with the market itself, obviously. And we've seen recently that investors are very exuberant about the markets. Equity allocations are at all-time highs for households. Bullish sentiment is very elevated. And so we've seen these positions before, and as we've been talking about for the last month or so, it's that typically precedes a correction. Doesn't mean right away, right? And this is the mistake that people make, is like you say, okay, well, here's this indicator and it's at a very high level. And then immediately everybody assumes that, that means the market's going to crash tomorrow. And then it doesn't. And then everybody goes, well, you're wrong. The market didn't crash. It does. That's not how indicators work. I just say that the risk of a correction is becoming more elevated, and you need to be paying attention to it. It's like a flashing yellow light. If you're speeding down the freeway and the light goes from green to yellow, I know you accelerate faster, but you should at least be paying attention to what's going on, right? And that's all we're saying here, is that that's what these indicators have been saying. But, this goes into a lot of the psychology of the markets and irrational exuberance. And Mike just wrote an article this past week talking about irrational exuberance on the website, realinvestmentadvice.com, by the way. But yeah, Mike, it's a very interesting article looking back at, irrational exuberance and, kind of, then versus now and kind of where we are, and this kind of feeds into this whole sentiment cycle. Everybody's been very bullish on markets in general.
Yeah. So before we start, I stole this article from John Maynard Keynes, a great economist from 100 or so years ago. And he basically said these words: it's the market can stay irrational longer than you can stay solvent. And all I did was take those 10 or 12 words and turn it into 1,000+ words. That's the bottom line. So I went back to 1986, December 1986, Alan Greenspan, who was running the Fed at the time, basically in a speech said that he said he was worried. He used the word irrational exuberance to describe a stock market that was trading at the highest valuation since the Great Depression, whose performance was, in 96, it had gone up 250% from the last recession in 1990, and it was behaving very similar to it is today. This was in 96. As we know, in hindsight, the market would rally for 3 more years and dwarf those levels, both valuation and price levels, that existed when Greenspan called it irrational exuberance. And the point is, yes, you can listen to a lot of pundits, like John Hussman is just out, and he's telling you how overvalued this market is. He is 100% correct. And he is right that at some point it will correct. The problem is it's not going to correct because it hits a magic number or because someone says it's overvaluated. The market has a mind of its own, and that mind is sentiment. And excuse me, as long as sentiment remains strong, the market can become more and more irrational. It can go higher and higher. And like Greenspan saw, it went on for 3 years. So if you thought, if in late 1996 you said, oh, well, even the Fed chair is calling out this market, and look at valuations are almost where they were in 1929. This is scary. I got to get out. Well, you gave up 3 years of significant returns. Look, it doesn't mean that the market won't eventually correct, though, either. But it means be careful. Right. It means understand where the risk is. Pay attention to your technicals, to your fundamentals, to the economy, to what the Fed is doing, and appreciate the market for what it is. But, you can be very bearish, but also appreciate that a bullish market doesn't have to run up on a strong economy and significant growth in earnings. It can run up purely because people are willing to pay more for $1 of earnings today than they were yesterday.
So, and that's interesting. And a lot of this plays into, not only just sentiment to where we are, but also plays into Fed policy. And as we've talked about over the last decade, there's just been kind of one repeated intervention after another. And we've had this fantastic 500% return in the markets from the 2009 kind of lows that's been supported by $43 trillion worth of interventions, whether it was quantitative easing or HAMP, HARP, TARP, a variety of government interventions, infrastructure spending, et cetera. There's been just this massive monetary push that's, pushed asset prices higher, that's boosted sentiment. We haven't gotten a lot of economic growth out of it. The economy grew at about 2%. Inflation was about 2%. During that period, the Fed was begging to try to get inflation up, couldn't get it up, despite all this money that was being poured into the markets. But sentiment was good and people made a lot of money. But, it's interesting now is that, and we've got a few minutes here and we'll probably have to finish this up on the other side of the break. But, now we're talking about interest. The Fed hiked interest rates one of the most aggressive rate hiking campaigns really since we've seen since the late 70s. And now we're talking about the first set of rate cuts since really the 2020 pandemic, when we shut down the economy and the Fed cut rates then. This will be the first set of rate cuts since 2020. And but inflation isn't back to target yet. And it's interesting because, and this is something you wrote about just recently, talking about that interest rates really are too high. But there's a lot of discussion that inflation has now stepped up to a permanently, higher level. And, if we take a look at what's happening economically and kind of where the average consumer is on wage growth, et cetera, that's hard to really suggest that we've stepped up economic growth and inflation to a new higher level that we haven't seen since the turn of the century. So just kind of wanted to get you to weigh in on that a bit.
Yeah, I mean, look, where there are some factors that are driving prices up, but at the end of the day, if you believe that inflation has stepped up, you have to believe something has materially changed in this economy. There's actually a lot more unproductive debt outstanding that has already benefited the economy and now weighs on the economy. Demographics are not getting any better, nor are they projected to get any better in the next 20, 30 years. So, and productivity continues, the growth rate of productivity. Productivity is still increasing, but the growth rate of productivity is still in decline. And the Fed publishes what they call their R-star, which is basically what they think is the natural real rate of growth of the economy. And when you add that with expected inflation, you get where they think Fed funds should be. Again, it's impossible to calculate, but that too is a declining number. So if someone's going to tell me the economy is going to start growing at a quicker rate than it was before the pandemic and inflation is going to be higher, that may sound good and may make headlines, but what's the evidence? Mm-hmm. The fact that we're going to nationalize a few industries and pay more? I mean, there's nothing in the broader economy that really is overly concerning that inflation is going to be higher.
Right.
And here's the other thing, right? We were struggling to get to 2% inflation. Let's just say they're correct and that inflation is going to be running 2.5% or 3%. Fed funds are still too high. It's still too high. When inflation was 2% or below, mm-hmm. the 10-year bond was somewhere between 1.5% and let's say 2.5%, 3%. So if you raise up that inflation rate a little bit, you're still too high on 10-year bonds and certainly Fed funds.
Right.
So even if you do have that belief that the natural rate of inflation is going to be higher going forward, interest rates are too high and they will push down on the economy, which will ultimately result in lower interest rates.
Well, and this is kind of the $1 million question, which is if we look back at how we, again, this is always kind of fascinating to me, is that because if you talk to economists, they're like, oh, well, look how the economy's growing and we're doing all these things and, this is happening and that's happening with the economy and that's why the economy is going to continue to grow stronger. But they always seem to forget that all of this has been a function of one-off monetary policies of, stimulus checks to households, the Inflation Reduction Act, the CHIPS Act, which is all fine, but that's all debt-driven spending that has to be repaid at some point, and it's a one-time impulse. It's not a natural organic process of stronger economic activity where the average American consumer is becoming wealthier. They have more money to spend, wages are rising, and they're able to spend more money, which is producing more demand in the economy, which increases wages, which allows them to spend more money. We're not seeing that. Wage growth is declining and all these one-time monetary inputs are fading. So if you just strip out those monetary inputs, you're going to wind up back where you were before we started all this nonsense. And that's the one thing that about economists that kind of escapes me.
You're left with the hangover.
Yeah.
And that's what we're going to have from all that debt that's outstanding is the hangover because we've already had our buzz.
Yep. Quick break. We'll come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So in the comments, some people are asking for a photo of Mike when he was in high school so they could see if he had a fro back then. The problem with photos is that Mike and I are so old that the only way you could get a photo when we were growing up was commit a crime, so the sketch artist would do a wanted poster. So, right. And he still had a fro back then, so I don't know, but, you know.
But in my high school yearbook, I had both a fro and a mullet, so...
So party in the front, business in the front, party in the back. Got it.
And the hair went down further down. You didn't have as much.
Yeah, my high school photo. I was a guitar player back in high school, and so my big idol in high school was Peter Frampton. So I had the aviator blue glasses because I was nearsighted. So I had the aviator blue glasses and long hair. So, yeah.
Could you make that noise he made with the microphone? Wah wah wah.
Yeah.
You know,
Yeah, actually I could. I had the voice mic for it. So yeah, we did a lot of that high school. What was it? High school talent shows. Yeah, all that. Yeah. So those were the days. Anyway, and no, we will not be sharing those pictures on air ever. They are buried and forgotten. Anyway. So just get ready to wrap the show. So Mike, this morning futures pointing down here just a smidge. We'll see what happens this morning. But, you know, I kind of gave a rundown, you know, at the beginning of the show on the correction yesterday. Again, you know, we've been talking about having a correction now for a good bit. We took some profits out of, you know, our big mega cap stocks. Things had gotten pretty overweight. And I just think it's important to keep things in perspective. You know, it's very interesting. We go through these corrections like, oh my gosh, your mega caps are selling off. NVIDIA's up over 100% this year, right? So yeah, it's having a bit of a correction. Who cares? You know, right. If you owned, if NVIDIA was your own was all of your portfolio, you're vastly outperforming the market this year. So who cares if you're getting a little bit of a correction? You know, it's just always interesting is that we just don't keep things in perspective, and you know, this is a hard challenge. You know, when managing money. Is, you know, one of the biggest things that we do as investors that's a very terrible habit is that we watermark our portfolio. So we look at our portfolio at the high watermark and we measure everything off of that. It's like, oh, I was at, you know, $100,000 in my portfolio last week. Now I'm at 90,000. Oh my gosh, I'm losing all this money. Well, where were you at the beginning of the year? I was at 70,000, right? I'm still up 20 grand for the year. I'm just making up numbers, but you get my point. is that the worst thing that we do as investors is that we benchmark our portfolio to the highest point, and then we consider ourselves to be losing money from that point if the market corrects. The markets are always going to correct. As I said this morning, we went almost 350 days without a 2% correction. You have a 2% correction yesterday, my email box fills up with people going, oh my gosh, is this the crash, right? No, it's a correction. We've been talking about a correction now for a month and a half ad nauseum, and here it is. So it's not really a surprise. But Mike, did you have any, insight into yesterday about anything going on with the market that surprised you?
Yeah, just kind of looking back over this has been going on for about 2 weeks. This more feels like someone is blowing up. And that's kind of a term the market uses when a big hedge fund or a big fund is forced to get out of positions. So keep in mind, these hedge funds and other types of funds are massively leveraged. So they're often very sensitive to price declines or price increases if they're short, depending on which way they're going. And if the price changes quick enough, whoever lent them that money is going to say, you need to put up more money or you need to sell, get out of part of your trade. And the violence with which we've seen the rotations, so large cap and small cap and, growth and value, and some of the reversals that we saw a couple of days ago, and then yesterday's trade there were, a decent handful of stocks that were up yesterday, despite the S&P being down over 100. So it seems to me that someone blew up. Another clue is that the yen has traded really well. And we know that there's a lot of traders, a lot of hedge funds that borrow money in yen and then they put a trade on. So, there's a very logical explanation that multiple of these traders were borrowing yen and they were buying the large cap stocks, the Magnificent Seven, selling the Russell 2000 or some other small cap type index, short that. And that was a pair trade backed by them borrowing yen at basically 0%. Yeah. Makes a ton of sense.
Right. And this brings up a hugely important point that, John, I'm going to cover your face up for just a second, Mike. So I'm sorry, but, just.
They probably thank you.
Yeah, probably. But this is a tweet I put out yesterday. And this goes to your point, Mike. And I know you can't see the tweet right now, but I'm going to read it. I said yesterday, hedge funds are very long equities and not really hedged all that much. So basically, if you're paying for a high fee for a hedge fund, they aren't really hedged, which means you mostly own a really expensive S&P index fund. And there's a chart here showing that hedge funds are very, very not hedged, right? They have very little shorts against the S&P. They're mostly long equity. And so to your point, if somebody got caught, sorry about that, Brent, but if somebody got caught short yesterday or a couple of days ago, and all of a sudden they've got to start shorting the S&P to hedge their portfolio, it just, to your point, they're leveraged. Now they're having to sell their long positions to now short the S&P. It just fuels this all at once. And so again, once we saw that break, it was interesting because we broke that 20-day moving average yesterday morning, and it just accelerated to the downside. It was, all those kind of algorithms and things just kicked in all at once, and all that shorting had to happen, which was just fed the downside. So to your point, right, that's exactly what's kind of going on.
And then you get margin calls, and a margin call means they either have to sell or they have to put up more money. So they're forced to sell. So if you have to sell, let's just say you have 1 million shares of NVIDIA. That's a lot of shares of NVIDIA. And you want to sell. You would just sprinkle them out to the market periodically throughout the day. It may take you a week or 2 weeks to sell it all. If the bank comes to you and says, we need money in 3 hours, what are you going to do? You're going to dump your NVIDIA shares on the market. And that just means you're just constantly showing the market a ton of shares and just pushing that price down, because it's more important for you to get out than to get the best price possible. So that's why I say it feels like someone or multiple funds are blowing up. They're being forced to liquidate. This isn't the kind of liquidation where where you kind of spread out your shares and you try to not affect the market. You want to get the best price. So the good thing about these type of events is that quite often they don't last very long. And once those players kind of get out of the way, the market can kind of get back to some form of normal. The problem, however, can be that it spreads and it forces more people into the same situation. So, again, we're dealing with this kind of stuff all the time. And we know a lot of people are off sides. They were long, large cap stocks and short value and small cap stocks. So there's going to be many players just trying to cover some of those bets to some degree, but the large majority are going to do so in ways that aren't going to push down on the market. They're going to try to be basically unseen. They don't want anyone to know what they're doing because they want to get the best price possible.
Right. Well, and again, it's just important to try to keep, again, we're going to hear a bunch of headlines coming out over the course of the next few days. It's like, oh my gosh, the market's crashing now because of A, B, or C. And, it's the end of the bull market, the bear market's back. And, it's not the case. And look, we get into a 5 or a 10% correction, which is very possible between now and October. August tends to be a very negative flow month in terms of money flows into markets. August tends to be very negative. October tends to be weak. That's normally when you have your major market crashes historically. For some reason, it's always October. Don't know why. But, crash of 87, they all happen in October. But more importantly, because we're going into the election, we could, and again, depends on what happens with, Harris or whoever the Democratic nominee winds up to be. Right now, it looks like to be Harris. But what happens between Harris and Trump, right? As they start, promoting their campaign, going on the campaign trail, markets start trying to weigh out possibilities of who wins and gets into the White House, who's going to win the House and the Senate. All those things are going to start to weigh on markets a little bit, and then markets will start to hedge. So this decline that we're seeing now is a little bit earlier than anticipated, but it doesn't mean that it's off base from kind of the historical normal trends of what happens during the summer months, particularly in a presidential election year. So this could be a 5 to a 10% correction. And just like in October of last year, when we were down 10% from the peak, headlines were rampant with the bear market's back. It's all over. And we were talking about then is like, look, this is the time to start buying because sentiment was extremely negative. Flows were extremely negative. And you had the perfect setup for a bottom in the markets. Right now, everybody's still very bullish. So we've got to work off all that bullish sentiment that's going on. The positioning is very long right now. We've got to reverse that positioning a bit. That's going to require more of a correction. Doesn't mean it's going to happen all at once. It could. We could have a very sharp down spike in the markets, be down 10% in a couple of days, done, right? But it could take a couple of months like it did last year. We went August, September, October, and kind of this grind lower, working off all that sentiment. And, it was a tough road. And we could see that again. So what Mike and I are talking about is just be aware, manage your risk, pay attention to what's going on in the markets, but don't overact, right? Just let the market tell you what to do. Be patient, move small, and you'll navigate this a lot better. Okay, that wraps up the show for the day. Mike, thanks so much. Of course, we'll be back here tomorrow with Financial Fitness Friday, and we'll take care of all your questions and comments. Go by the website, realinvestmentadvice.com. Have a great day.